Hey everybody, it's Kevin. Hope you're doing great. This is a presentation, so it's not going to be just a quick video. I'm going to be showing some slides, some charts, data, but the main issue here is it time to be defensive? Okay, we're in December of 2018 and the markets have not done well this year, and it's really interesting to me, having worked in pharmaceuticals. Doctors said that there were teachable moments, and they were talking about when a patient would have a heart attack or get diagnosed with diabetes or some other type of health crisis, that people would be much more interested in learning about things. So we believe that when markets go bad, that is a time to educate. If you look back at all the videos that we've made over the last number of years, many of them are about when markets go down, when markets crash. And in the last couple of years, people have even asked me, why do you constantly talk about that? Well, it's very important to know how to behave when markets do go bad, to, I think, behave in the right way, because these are the times when we can really, these are the danger zones of when we can really mess up our future. But again, these are our beliefs, and I'm going to share them with you, share the evidence. Is it time to be defensive would be one title. The other title is, what the heck is going on with markets? So we're going to talk about that in this presentation. So first of all, let's look at a worldwide portfolio of companies. And this is the 73% North America, and the rest of the world is 27%. Now, there was a time period, the Great Recession, 2000 to 2009, that's 10 years, where the North American S&P 500, the stock market in the U.S., was actually down for a 10-year period. And so we do believe in worldwide portfolios, but I'm not going to go deep into that today. It's more just about what's going on and what we believe. So this is 2018, and the worldwide portfolio was up 6.75% in January 26th. This was the peak of the most recent, the market high, if you will. And then the market went down, and then it kind of went sideways. And then you can see here recently, things are not looking too good. So this is 7.27% down as of December 7th. So the peak is January 26th. The trough is December 7th, and it could be, going down even today as I make this video, is 7.27% down. That's a 14.2% correction. A correction is 10%, a bear market is more than 20. So we're somewhere between the correction and the bear market phase. And the question we get asked is it going to keep going down? Or some people are saying it is going to keep going down. And so let's first look at 10 years with the same portfolio. If you invested in 10 years, and when we talk about stock investing in REITs and other type of highly return, highly risk assets, we're talking about longer periods of time. Even with this, downturn here, which does not look as extraordinary when you look at periods of time, but day to day, this is when we can make decisions that can really harm our future. So, by the way, if you take 72 and you divide it by 12, you get that your money would double. The rule of 72, your money would double every 6 years with this type of return. So we'd love to have these returns, over long periods of time, but short periods of time is when we can get very frustrated. So let's jump into the presentation here. And again, it's going to be a thoughtful presentation, so I'm not going to rush it. What can we control and what we believe at Leading Edge Financial Planning? And this is based on academic research. We believe in matching investments to time horizons. I'll talk to you more in a second about what this actually means. But to me, this is the most crucial thing that we can do as financial planners. Absolutely top tier when it comes to investments, matching financial plans. Asset allocation is the biggest key. Asset allocation is stocks, bonds, REITs, cash, whatever. Discipline, you'll always see discipline in investing. You'll always see that. But discipline and dogma are similar words, but dogma is a negative word when things go bad, because you think, well, that person just believes whatever they believe and they're stubborn. But we'll talk about discipline versus dogma in investing. The next one is that when you look at your accounts, when you look at your value, you're not just owning blips on a screen or positive and negative returns. You're owning stock funds. You're owning U.S. and you're owning world companies. And so if companies are going to continue to make diapers and if companies are going to make cars, other products you use, toothpaste, soda, or pop, or whatever you call it in your part of the country, if they are continuing to make it, then market prices can go up and down. If you own your own company, would you all of a sudden abandon that company when you just have a bad period of time? You probably would not. And so we remind everyone that you're owning U.S. and world companies right now. And yes, the value is less, but it's not like it's worthless. And then our behavior, I said this is the most important for us to do. This is the most important for all of us to do together, is our behavior. And Benjamin Graham, who taught Warren Buffett, said the investor's chief problem, even his worst enemy, is likely to be himself or herself. And I will share some evidence of that. So ask yourself how you did during the 2000 market crash, or the 2000 market correction, or the 2008 market correction or crash. How did they affect you today? When you look back on them, they were scary at the time. Markets went down. What did you do during those time periods? Some people say that's the reason why they came to work with us, because they did sell out at some point. Maybe not at the bottom. Most people, I've never met anyone that sold at the very bottom. Everyone got out at some period of time and then got back in. Some people just rode right through it. And those that rode them down and then up and lived off non-risky assets. What I mean here is that if you lived off your salary, or if you lived off of cash or bonds during these time periods and you didn't have to sell when markets were down, you did great. So this is what I talked about a second ago about matching investments to time horizons. If you need the money in 2018 or 2019, then you should have cash. Cash is not trash when it's for short-term investments, and cash now is paying something. If it's going to be 2 to 8 years, then you have lower and moderate risk investments. Okay? A blip in time doesn't matter, again, if you're going to use the money in the years to come. And we only want to put stocks, REITs, and other higher risk, higher return investments if it's going to be, some people would say 5 years, 8 years, 10 years, but some future period of time. You're matching the investments with the destination. So let's look at the last two market corrections, and we'll look at a worldwide portfolio. We'll look at the S&P 500, and then we'll look at the NASDAQ composite. The NASDAQ, the .com, the reason why so many people lost money and got in so much trouble is that they invested in all these tech companies that were screaming in 1998, 1999. And then the NASDAQ in this time period, which is January 1st of 2000 to December 7th of 2018, NASDAQ composite had a positive 2.88% return, but it was miserable. It was miserable. Recently, that's all everybody wanted to own was NASDAQ because it was screaming higher. I mean, the tech boom again happened in this 2016, 17, 18. Look at that, screaming higher. But for how many years, if you were non-diversified, did it take you to get back to even? It took you 14 years. S&P 500, again, positive return. And this is a cherry-picked time period, 2000 to 2018. Absolutely cherry-picked. 5% return for the S&P 500. The last 3 years, it's been very difficult to get people to believe that they should invest in anything but the S&P 500. But if you look at the worldwide portfolio compared to the S&P 500, they were very close up until a couple years ago. And so that's why we believe in the worldwide portfolio. When you look at longer periods of time, what if you were an accumulator during this time period and you kept buying, and you actually bought low and sold high? These market corrections for an accumulator is not bad. What about for someone that's retired? Well, somebody that's retired, you need to take less risk in your portfolio because you need to have money that you can harvest for 1 year or 2 years. You need to have money you can harvest for 2 to 8 years. But again, this time period, if all you owned was the S&P 500, it was miserable, and you had to wait a long time before you sold equities. But that's the point here, is that the last two bear markets, how did it affect you as we stand here today? You got positive returns. It wasn't the most pleasant, but if you kept on buying all this time period, you ended up doing much better than what these numbers show. Probably returns are closer to 9 or 10% because you bought mostly at the lows. Okay, so let's look at the actual returns. And this is a little confusing because the top is 10 years and the bottom is 20 years of returns. So the way that we would suggest you deal with the ups and downs in the market is decide on how much stocks and bonds to hold. Okay, they do move somewhat inversely. Even in the last month, bonds have actually come back up. Actually, bonds were down a little over 2%, and now they're down about 1%, and that's because when stocks have gone down, bonds have gone up. But if you owned a 100% portfolio of the S&P 500, you were down 50% from 2007 through March of 2009 was the time period right here. You got back to even 3 years later if you just owned the S&P 500. If you owned stocks and bonds, you got back to even. A 40-60 portfolio got back to even before the end of 2009. And then a 60-40 recovered a year and a half later. But these things are going to happen. And how did we know? Did we predict, did anyone predict that this was going to be the market crash? Not really. A few people did. But those people kept saying that we were going to crash all the way back up as well. So anyway, here are the returns over the last 20 years. Real estate investment trusts, 9.1%. S&P, 7.2%. 60-40, 40-60. This is Europe, Far East, Australasia. Now here's really the takeaway point on the bottom here, is the average investor did 2.6%. The average investor actually did worse than most of their investments. Why did the average investor do worse? Well, part of it is cost to invest, but the biggest part is the behavioral problem of people selling at some point, and usually they're not selling, they're going into something different. That's the way we think about it. We say, well, we're going to go to bonds now until things get better. Well, I can remind everyone that all the way up here, people every day predict the market is going to crash again. That's the plight of the investor. There's always people on the news and your friends that are saying the market's going down. And we hear that every day as well. And so diversification helps with that. So again, the returns available over the last 10 years, 12.29% is awesome. Even with this market, correction that we're in right now. But all that data still makes the limbic part of our brain say, but seriously, what's going on? Why is the market doing this? Well, I'm not going to give you answers why the market is down. You've probably heard them all if you've been paying attention to news. But there's uncertainty right now. There's uncertainty on if we'll go into another recession. There's uncertainty about bond rates. There's uncertainty about inflation. There's uncertainty about trade tariffs. But the main point is here is, okay, so we are here today. Is the market going to continue to go down? And so this slide here, the main purpose of this is the market is. So this type of language is just plain wrong. To say the market is inferring that it's going to continue to go down. If you say the market is going down, that means you're thinking in your mind that it's going to continue to go down. So is should be replaced with has or has been going down. Because the thing that we know about market history, and I'll share this with you, is that there's either subtle or violent directional changes in markets that are likely either way. If all the things that we think are so bad right now go away, well, then the market goes back up. Or something new takes over that brings the market up. Or something worse happens and the market continues down. But just saying the market is just, we're setting ourselves up to want to sell. There is an innate desire in all human beings to take away the short-term pain. This is pain. If you pay attention, it's pain. So we have a human desire to avoid pain, seek safety, whatever you want to call it. It's just a human desire. what if you could just say, whatever the markets do, I'm going to fly with the market through the ups and downs. I'm going to go through the market with the ups and downs. We talk about that with clients constantly, and when times when markets go up, it's easy to do it and say you'll do it. But in the long run, this is from Peter Lynch, it's not just how much money you make that will determine your future prosperity. It's how much of that money you put to work by saving and investing it. There's an opportunity whenever markets go down and you are an accumulator to buy at lower prices. There absolutely is an opportunity. If you are retired, then your portfolio is in a different position. You should have money that you can live off of for years to come, and then it should be, and I use the terminology, should be irrelevant if markets go down. So let's look at history. This is from 1926 to 12 of 2017, so last year. And so an average annualized return after a market decline of 10% or more. And you can see 1 year ahead, markets were up 11.2. 3 years ahead, markets were up 10.2. And 5 years ahead, markets were up 9.6. So just because the market, and I'll use the terminology, is going down, which really it has been going down, does not mean it will continue. It may, and then it will become a bear market and maybe a market crash, but it may not. Being so sure is really a bad decision. But let's look at the binary decision number one. Can I sell now and buy at the right time? So can I sell right now and then get back in? William Sharpe, Nobel Prize winner, said you must be right with market timing 74% of the time. So 74% of the time you must sell at a time and then buy at a time that is better than just buying and holding. 74%. Remember that number. I've seen other scholars and mathematicians say it's 82%, but you have to be right a heck of a lot of time. There's people that got out of the market in 2010, 2011, 2012, and they never got back in because they kept waiting for the market to go back down again. So let's look at the track record of some famous gurus, and it's from CXO Advisory. There's two videos here, one by Burton Malkiel, and his name got cut off. The other is by Warren Buffett. And they both say the same thing. Well, I won't say they say the same thing. Burton Malkiel says that market timing is dangerous. It's not just bad, it's dangerous. And watch that video. And then Warren Buffett says that if you are not willing to have your portfolio cut by 25%, then you should not be investing in markets. And for some people, investing in stocks and bonds is not the way to go, because it's just something they can't handle the volatility. But what we believe is invest through market downturns. If you're an accumulator, it's the best time to buy more. Now, we don't know if the market's going to continue to go down or go up, but it's always a good time to be buying more. And use other asset classes to live off of if you are retired. So don't sell into this market pressure. So again, when we look at charts over the long term, small cap, large cap, and government bonds have stayed ahead of inflation. Now, is there a guarantee that we will have future returns that look the same? No. There's not a guarantee. That's the reason why investment returns can be so high for these types of asset classes, because there's no guarantee. Now let's look at the famous gurus that have made predictions that are out there in the public. Now maybe they've made some private ones as well, but the gurus that have predicted the greatest are David Nasser, Ken Fisher, and others. But none of them predicted enough to, if they bought and sold and sold and bought, that they would have been able to do better than a buy and hold investment style. None of them. And you look at some of these people, how poorly their predictions are about their forecasts for future markets. Most of the people were below 50%, and these are the famous people. These are the famous people. So to be a market timer, you have to be right almost 80% of the time, and it's almost impossible to do it. But how do we fool ourselves into market timing? Everybody says, this one down here, I think, they say, I'm not a market timer, I just believe. That's what we hear, that's what we feel. Charlie and I feel the same thing you do. about fooling ourselves that maybe we should be doing something. Is it a good time to be defensive? That's another way we hear it. The market just seems messed up right now. So let's get out right now and get back in. We have a belief that we will get out before the next big one. This is something that I found with clients that I've worked with for years, and then one day they've said to me, you know, well, I'll get back out before the market crash. And it's not just hard to do, it's impossible to do. Because we don't know that there's a market crash until it's actually down a certain percentage of dollars. And then by that point, if you sell when market prices are a lot lower, then you're locking in those losses. And you've already been hit with the risk of owning the asset classes. Markets can always keep going down, but you've been hit. Things have changed. That's another one. Things are different now. Today is really bad. I just have a feeling. That's another one. And so it is so obvious that the market would go down. That's something that we got a email from a pilot, and he said that he wanted a new financial advisor because it was so obvious the market would go down in January and again in October, and they did not get him out. And they told him not to market time. But I would suggest that we hear bad news all the time as financial planners and advisors, and you hear bad news all the time. It's just when, all of a sudden markets get volatile that we actually say, well, that was obvious, but it's always after the fact. And the inverted yield curve always predicts recessions, and I'll show you something about the inverted yield curve. A big challenge for an advisor, our biggest challenge, is to help clients understand that down markets are a normal outcome. And no, we don't need to adjust the portfolio because this quarter it went down. This was in the range of perfectly reasonable outcomes. This is Kenneth French of Fama and French, and he says that's probably our biggest challenge, and I do think it's the biggest challenge. If you liked all these companies and you liked investing in the world of companies when prices were up, why all of a sudden, now that they're on sale, is it a bad time to own them? So the second decision is, should we be dogmatic? And I use the word dogmatic on purpose. Some people would call it discipline, in our view, or change our investment beliefs during market downturns. Okay, has something changed? Well, we believe in buy and hold and rebalance during market upturns. But when markets go down, what should we believe? Well, I think we should still believe the same thing. Most people that work with leading edge financial planning, because they know that we can help them stick with their plan, stick with their discipline, set up a plan and stick with it. That's really the key. And then I would say discipline and dogmatic are very similar in investing. I'll tell you a quick story. So one of the other advisors we worked with at the other firm, he got written a really, really tough letter from someone. And the letter said that that advisor had ruined his future because he was so dogmatic in his beliefs about investing, and that he really was sick that this person was so dogmatic, and you may want to consider not being so dogmatic. And the letter was written at the beginning of 2009, and of course the markets came back, and the person kept asking the advisor, should we sell, should we sell, should we sell, should we sell, and then wrote that letter and then sold, fired the advisor, and then a few years later, of course, everything would have worked out. But, there's no guarantee that will always happen, but it sure looks that way. And then the final thing is that the grass is always greener. And short-termism is the enemy of long-term returns. It always looks like you should be doing something different. Oh, and by the way, Charlie and I will look very stupid at times when we say to stay the course, but so will Warren Buffett, Jack Bogle, and others that believe that this investment style is the best way to go. Again, it's about behavior, and most market time periods in the past and probably in the future will be similar. Now, if the world does go bankrupt, I had an intern a few years ago, and he said, Kevin, you believe that markets will go higher in the long run? And I said, yeah, that's really the one deal breaker, is if you don't believe that markets will return in the future, well, then don't invest in markets this way. Be someone that keeps your money in the bank. Don't be a trader. Don't be someone that market times, don't be involved with the market, because you'll probably do just as well owning treasury bills. But you must know yourself. That's the key, knowing yourself. But, the strategy is based on probabilities. That's the reason why we believe it's a good idea to stay the course. So should we make predictions or should we not make decisions about future based on our predictions? We all are constantly predicting. Human beings want to make sense of the future. The things we hear in predictions are the Fed will, interest rates are too high, the market is going lower, the market is at a top. The market's been at a top, I can't tell you how many times, hundreds or thousands of times in the future. Trump will, we are due for a recession, and then this is one of the biggest ones constantly, is that country, whatever, is in big trouble, and that will crash the market. And then the final one is whatever you think is the reason why we should make predictions and we should change our investment styles. Now again, Charlie and I, the one thing we could be wrong about is if the world does go bankrupt, our investment style, again, will not work. But other than the world going bankrupt, as long as people still are buying diapers and buying cars and using products and using services, most likely the market will return. Okay, so now I just used the terminology market, and actually there's tons of markets. So 2003 to 2017, emerging markets was the number one asset class for returns, 12.7% over this time period, and this is from JP Morgan. The interesting part is that emerging markets did really well at the beginning, had some really terrible years, and the last 2 years have done very well up until 2018. It's a very volatile class. If you're going to invest in emerging markets, don't invest in them for 5 minutes. You are going to hate it because they are going to go down at certain periods of time. That's why they give you potentially higher expected returns. Small cap, same thing. If you invest in small cap, there are times that you wish you didn't. And small cap just means the smaller publicly traded companies. Now, 2016, Yahoo! 2013, it was the best asset class. But again, a diversified portfolio means that you will hold all of these things. And year to date through November 30th, small caps were up. Large caps were up more. REITs, 11.1%. Year to date, REITs are an asset class that are still positive. So having some REITs in there is great, but in 2017, not so great. High yield stocks, high yield bonds or junk bonds. I missed large cap. Here are large cap for the last 15 years, 9.9%. So yeah, own some large cap US. This is large cap US. This is small cap US. Definitely own some. But putting all your eggs in one basket, I would argue, is not diversified. This is developed market equities. Had a positive return of, I think that's 8.6%. If you had an asset allocation of all of the different types of investments that you see here, 8.3, fixed income 4.1, cash barely or did not keep up with inflation, and then commodities were negative. But the point here is that you don't own just one market when you invest. You own multiple markets, and this diversification benefit I think is there, and that's why we believe it. But there's going to be times where whatever you own, the grass will be greener on the other side. So 2 more thought experiments for you. So let's say that you own this house right here, and every day you leave this garage, you pull out through the driveway, and there's a person standing there at the mailbox and says, your house went down 1% today. And you say, my house went down 1%? And they say, yep. Based on all the stuff I know, your house went down 1%. Next day you come out and they say your house is up 2%. And then the third day they give you an app on your phone that you can check how much your house is up or down every 5 minutes. And then they make it so you can check it at all times. Now the question I have for you is, if you're going to continue to live in this house for 8 to 10 years, does it matter what the price is on any given day? Well, when you get out to 8 or 10 years, it does matter. But today, it shouldn't really matter because you're going to live in the house. Now, it's not a perfect metaphor, analogy for investing in stocks, but the point is, the hard part about investing in stocks is that we get a report card every single day, And when you're a successful person, if you don't get good grades, it's very upsetting. But does it really matter? That comes back to the eight years plus, stocks, REITs, and higher risk. We only invest in these types of assets if it's going to be for longer term. Now, here's the second thought experiment. This is a fine-looking young man right here, first officer, Charlie Mattingly. Piloting a jet with multiple route changes. So you're taking off. We work with a lot of pilots. You're taking off, and during the flight, there's let's say half a dozen route changes. But you still arrive, and there's a rainbow right there. You still arrive exactly when you're supposed to arrive to your destination. Did it really matter that you had to take all these route changes? Now, one could argue, yes, gas. You had to burn more gas. I mean, I know there's a lot of things that pilots are thinking about right now. But the point is that if you arrive at your destination on time, does it really matter as long as the ride was comfortable? Well, investing in markets is not comfortable. And there will be many good and tough times. You will have to make changes, route changes. It's not going to be a linear investment. What's the word for it? You're not going to have a linear improvement in your investment accounts all the time. You are going to experience some tough times. But does it really matter if when you get to the destination of when you need that money, if the money has grown? And that's really the probabilistic thinking that we think we should think about. Again, if your destination is 8 years from now or 10 years from now, then it should not matter. But here's the really hard part for people. We work with a lot of successful people, and I'm not just saying that to kiss up. People that have money or are achieving financial success, they've been successful in whatever they do. Investing through down markets means, by definition, your investments will be losers sometimes. And we believe in telling clients that truth. I mean, that's a truth, that there's going to be times, there's going to be days like this, if you will. From all the evidence, no one has consistently been able to avoid investment losses if their desire is to have higher returns from the investments. And so here's another quote from Peter Lynch. You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in markets. And so these down times are hard, but if you don't expect them, you won't do well in markets. Now, I think this whole inverted yield curve is super interesting, not because I want you to know exactly what an inverted yield curve is, but the last week on the news, they've been saying, oh, inverted yield curve, that predicts recessions. The market is going to go down. And that is what spooked the market, I think, last week. That's why the market was down 4% last week. But what we know about inverted yield curves, and then what do we not know about inverted yield curves? Well, first of all, this is a history of the inverted yield curves since they've been paying attention. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9 data points here. So what we do not know is over really long periods of time in the U.S., have these inversions always predicted a recession? Because there's only 9 data points. That's terrible. If you were doing a clinical trial for human beings with medicine and you had an N of 9, would you believe that? Well, okay. But what we do know is what happened in the past. And so the first one happened January 12th, 1966. 3-month Treasury bills yielded a higher interest rate than 10-year Treasury bonds did. It turned out that the market 12 months later was down 9.3%. So the market did go down. But as far as when the recession came, it didn't happen. It was a false alarm. And then it happened again in the same year. This time, the next 12 months, the market went up 24%. Again, a false alarm. So we have 2 false alarms, and we have one that the market is down 9%, and the other where the market's up 24%. 1968. Yes. Not only were your investments down, a recession came within a year. 1973. Yes. Markets were down. Recession came in 9 months. Okay, July 4th, if you said, all right, there's an inversion, let's sell all our investments. Well, you missed 7.7% return in the next 12 months. That's the hard part of selling, market timing, and then trying to get back in. And there was a recession, but it wasn't for a year and a half. So in 78, you wanted to hold. In the summer of 79, you wanted to sell. September 1st, 1980. Okay, there was a recession, and the market in the 12 months barely was better than holding money in the mattress. 1989, 12 months after the recession, or excuse me, after the inversion, you would have had a double-digit return. A recession did come, though, in 14 months. So again, you wanted to hold for a year after the inversion. When I say you wanted to hold, I'm joking about that because, again, it's very hard to do that. Now, September 10th, 1998, we had another inversion, and a recession didn't come for almost 3 years. And I've heard on TV that people have said, well, it always predicts a recession. Well, recessions come every 4 or 5 years anyway, so did it really predict? I don't know. And then 2006, again, if you sold at the time of the inversion, yes, there was a recession. So in most of these cases, there was a recession. In some of these cases, it was within a year. But it wasn't a perfect prediction. So, and there's only nine data points here. So I guess the question is, should you use these kind of things and use these predictions? Well, let's look at actually what happens when there's downturns, because one of the key things we believe is when there's market calamities, it's a really good idea to look at history of what happened in other market calamities. So since 1926, these are the 10% threshold for downturn. So these are corrections. Now this correction was the mother of all corrections, 83% down. It was over 34 months, very painful. Then we had a great bull market. It increased 815%. You can see correction, increase, correction, correction, increase. The worst time to retire was in 1966, the year I was born. Okay, and the reason why it was such a bad time to retire is we kept having these multiple corrections. And the market was somewhat flat all of these years, and it was very hard to be an investor. Now, if you were an accumulator in the 70s and 60s, then you did fantastic. But if you retired in 1966, that was a tough time. And then you see some of these great bull markets and then some bears. The point here is that we do have corrections, but should you invest to avoid these corrections, or should you invest to try to get good returns over long periods of time? That's really the question. Now, these are 20% downturns, and you can see they're less common, but you know, we're down 14% worldwide today. Is that like something wrong with the markets? No. We've had major corrections. And then what happens after there is a correction? Well, if you hold 60% equities and 40% bonds, this is what happened. 1 year after the 87 market crash, you would have been up 19%. 3 years, 33, and then 5 years, you would have been up 76%. So, you know, when the market crashed, if you held on, it came back. 1989. September of 1998, the Asian contagion, the Russian crisis. Then we had the dot-com crash. The dot-com crash was pretty extraordinary because after 1 year, it didn't come back. After 3 years, it didn't come back. This is why owning investments is not easy for everybody. It's hard to be patient when you're, especially like I said before, when you're a successful person and you're a winner. Gosh darn it, I'm not used to not winning. Well, markets did not have return. And this was September 11th, 81% after 5 years. Lehman bankruptcy, 47% after 5 years. Again, this was a slower comeback. I lost a steak dinner on this comeback with a good friend of mine because I bet him that the market would be back to even within 2 years, and I was wrong. It was 3 years. And then August 11th, we had a correction in August 11th. A 60-40 portfolio would have been returned. So I guess the major thing that I'm mentioning here is that people don't want to own bonds. But bonds go in a different direction typically when stocks go down, and that eases the burden of getting back to even. Now here's another argument for market timing, why you should not do it. Again, watch that video from Burton Malkiel or Warren Buffett. Those videos are great as far as why you should not market time. But if over this time period, 1990 to 2017, $1,000 became $13,000. That's an incredible growth. How many doubles is that? 1 became 2, 2 became 4, 4 became 8, 8 became 16. I mean, it's not quite that many doubles or compounding. But if you jumped out of the market and missed the best day, you got a lower return. If you missed the 25 best days, you got over half a return less. So the point here is that, yes, maybe you'll miss some of those down days if you jump out, but you'll also miss some of the best days because many times the best days come after the worst days. And so that's the reason why we don't think you should jump around. So this is what we believe is the greatest reason to have a financial advisor. Try to focus on things that are really the things that can add value. Create an investment plan to fit your needs and risk tolerance and stick with it. Structure a portfolio along the dimensions of expected returns. What are the returns historically? What do we expect that will show up eventually in the future? And use probabilistic thinking to develop a good portfolio. Diversify globally. Manage expenses, turnovers, and taxes. And then this is the reason why we're making this presentation, is stay disciplined through the market dips and swings. This is the hard part. And this is the reason why we all get paid the big bucks to invest in markets, because there are going to be days like this. So anyway, if you have any comments, questions, anything you even want to disagree with, that's perfectly fine. We like intellectual discussion, and we're happy to talk with you. Please get in touch with us if you'd like to talk about this or anything else. Thank you so much for watching. On behalf of Charlie Mattingly and myself, we think if we stay the course, that the returns will show up again. Thanks so much for listening and watching.